So good afternoon everyone, and welcome to the CRAD Mobile first half FY16 results presentation. We'd like to encourage everyone to ask as many questions as possible. For those of you that are using GoToWebinar as opposed to dialing into the phone line, there is a little chat box where you can basically send through your questions, and please work on the basis that if you have a question, there'll be others who also have a similar question. So, and we'll do our best to answer those questions. So moving forward, CRAD Mobile, we're a profitable and very much a global mobile first company. The rationale for using the words mobile first is that everything that we do at CRAD Mobile is based upon the cell phone, and as we know, consumers around the world are adopting smartphones. Consumers around the world are now, particularly in emerging markets, are using their mobile phone as their core entertainment device, and this is really the area that CRAD Mobile is tapping into. The company has offices in Amsterdam, Budapest and Melbourne, and as you can see from this particular slide, roughly 74% of our revenue comes out of Europe, and the remainder out of the Americas, Africa, Asia and Australia. And as part of what CRAD Mobile does, we also have reach into over 50 countries, so we are now selling our products to consumers, to millions of consumers around the world across 50 countries. CRAD Mobile has two core divisions. We have our Q&A, our question and answer division, which I'll spend a bit more time on, and then our mobile content subscription, which I'll go into a bit of detail as well. Everything that we do is underpinned by an M-Payments, a mobile payments network, which basically allows consumers to very easily bill the products that they're looking for to their mobile phone, whether it's through Apple, Google, or the 160, that's 160 mobile telcos around the world. We have a growing and diverse product portfolio across entertainment, infotainment, mobile security. Part of the products are created in-house. A number of the other products are licensed, so we have strong in-house as well as licensing capabilities. And the core demo for a lot of our products are the 16 to 35-year-old age group, and I'll certainly provide a bit more comments, a bit more commentary around what the future looks like in regards to the business. And I can see some questions coming through from Stella, and we'll basically do our best to answer all those questions, Stella. So thank you everyone for starting to send through, and John for sending through some questions as well. Now a little bit more about our Q&A apps. I just want to give everyone a bit of a flavour with regards to the business, and then we'll obviously spend a little bit more time on the financials, given that this is our December half presentation. So in regards to the Q&A business, and that's really providing a service to consumers around the world where they can have their questions answered within minutes. A trend that we've seen in this marketplace is that people are now looking for personalised information, personalised responses that go well beyond the capabilities of Google. And our view is that in a number of instances, you can only ever have another human being answering questions, and that's the only way to get a personalised response. And so that's the whole philosophy around our Q&A business. It answers to any of your questions within minutes. And how it works, without spending too much time on slide number 7, is that consumers through mobile apps, Mobi sites, i.e. HTML5 websites, as well as SMS, are able to ask questions directly into our Crowd Experts engine. Crowd Experts engine is basically a technology that we've created over the last 5 years which basically matches the question with the appropriate expert on the platform. The customer is able to pay for it. If you're in Australia, it's Telstra, Optus, Vodafone. If you're in the UK, it's BT or Voda or Orange in France, or TIM in Italy, Deutsche Telekom in Germany. And it makes it really easy for consumers around the world to pay for their products. Our engine it's a core tech that we've built. As of today, we've got over 1,000 experts on the platform answering questions in over 30 different languages. In the last 12 months, we've paid out over 2.5 million to our crowd experts. So we've actually got people earning real money. Roughly a third do this 8 hours a day, and the other 2/3 it's part-time, and they all get paid on a per question basis. So it's a variable cost from a business perspective. And recently we just launched an API which allows us to integrate the crowd experts technology into third-party apps, and there'll be a number of announcements in the not too distant future which basically will give some more insight in regards to how that works. Ultimately, the numbers speak for themselves. We've had 8 consecutive quarters of quarter-on-quarter growth. This quarter that we're in is no different. We're expecting another record quarter, and this is through a combination of launching new products, more products, and launching into more markets. Now moving on to our mobile subscription business. And this was very much created. This division was created from the recently acquired Track business, which is now entitled Crowd Mobile, our content subscription business. And this is basically a service where, once again, consumers all around the world are able to buy content. So think of it as games, entertainment, infotainment, or security products. So think of virus checkers. And other ways to personalize your mobile phone, as an example. So we will promote these products to consumers around the world. Then they click a button, or sometimes two, and are able to then subscribe to that content on a weekly basis. And it could be $2 or $4 or €5 or €3, depending upon the marketplace that we're in and the actual product. And then that is deducted from a user's mobile phone every week. And then just on slide number 12, it just gives a bit more insight into some of the products that we have. Not infotainment. I've also mentioned and should touch on music and video. There are a number of portals with some very good quality content there. And all the consumer does is click a button, gets added to their phone bill, and then we get paid anywhere from 90 to 120 days after the end of the month from the telcos. And as I mentioned earlier, we have relationships with over 160 telcos around the world. Moving forward in regards to our results, and this is where Christian will certainly provide some feedback as well. And just for the record, I know we have received some questions already, and we will be addressing those. But please bear with us. There may be certain questions that we cannot answer. In effect, we can only talk about information that is already in the public domain. And I know there's some questions that we've received that we're just not at liberty to answer at this particular point in time. So I just want to excuse ourselves for that. In regards to the highlight, half year revenue is up to 14 million, which is up 153%. Underlying EBITDA, and Christian will spend a bit more time on this, is up just shy of 90% to 2.2. And more importantly, and I think particularly important for a micro cap, is operating cash flow is up 1,500% to 3.2 million. What is important to note with regards to these results is that they only include 2 months of Track. So out of the 6 months for the December half, it only includes 2 months of Track. And as I think we all know, the contribution of Track is very strong. Moving forward, in terms of the run rate, which obviously only includes, which is October, November, December, which only once again includes 2 months of track. I'll hand it over to Christian to give us some insight.
Yeah, sure, thanks. So, guys, as you can see there, the December quarter run rate, which included 2 of 3 months, included track. The revenue was $9.5 million for the December quarter, with an underlying EBITDA of $2.4 million and a positive operating cash flow of $3.5 million. So again, with 2 months of track, you can see that the results are very strong. I should add that the operating cash flow, we did have the benefit of negotiating some terms during that December quarter, so it does represent a stronger cash flow during that quarter than is recurring. So there is a benefit within that. So our cash flow was very strong for the December quarter, again, as a result of receiving some of our trade debtors on more favourable terms. If we move on to the next slide, so I'm now on slide 16, we can see here that our message volumes for the December half was up 86% in our Q&A business versus December 14, which again we're very pleased with and continues, as Dominic said earlier, the quarter-on-quarter growth that we are experiencing. Our revenue again, 14 million for the December 15 half versus 5.5, up 155%. Our gross profit at 10.4 versus 3.7 in the prior half, up 181%. And that gross profit is before marketing costs. Our statutory EBITDA was minus 55,000 or minus 0.1 compared to a 900,000 profit for the prior year, which is when we were a private company. And the underlying EBITDA for the half, the December 15 half, was $2.2 million compared with $1.2 million, up 83% versus the prior period. And the underlying EBITDA has been adjusted for two things: share-based payments for financing and transaction and for incentive plans and for transaction costs for the track acquisition of 900,000. Our NPAT was a loss of minus 800,000 compared to 400,000 profit, which is down 300% versus December 14, again when we were a private company. But again, we revert to the December 15 quarter run rate, which shows that for that quarter our revenue was $9.5 million, our underlying EBITDA was $2.4 million, and our cash flow was very healthy at $3.5 million. So as we've said in this slide, this positions us for a record second half in the 2016 fiscal year. If we move on to slide 17, talk briefly about the shape of our balance sheet and our operating cash flow. Our cash on hand at the end of December was $5.9 million. Our total assets are almost $55 million, and a large component of those, of course, is intangible assets as a result of the track acquisition. Our total debt, $17.7 million, which is a combination of our European bank plus vendor debt that financed the track acquisition. Our total liability is $35 million and our net assets almost $20 million Aussie, which of course is significantly greater than it was at June 15 pre-acquisition, where they were only almost $3 million. We move on to our cash flow. We're very pleased with our positive operating cash flow for the December half. Again, we deliberately went out once we acquired track and reduced our trade debtor receivable cycle because, of course, we had more power with the telcos and the aggregators to reduce some of those terms. So we did have the benefit of getting in significant receipts from customers in the December 15 half, and more strong or stronger than would be recurring. Our net interest and tax, of course, now is a big one for us, given that we are a very profitable company, particularly in track, and we do have financing costs of around about 140,000 euro per month, so they are significant. Our investing and financing cash flows there relate to, of course, to track, so there's not a lot to say there other than we're pleased with the conversion of our EBITDA to cash flow. We continue to be pleased with it, but we should note and we should stress that we have interest cash payments month on month of euro $140,000. And perhaps if we move on to slide 18 now and just reiterate our debt position and the details of our debt funding. Our balance sheet debt is 17.7 million Aussie dollars at the end of December, which is in our financial statements is comprised of 13.4 million current liability and 4.3 million non-current liability. And there's a couple of accounting tricks in there, but the interest coverage is greater than 4.5 times. That debt is comprised of two things, of course. One is European bank debt, which was $4 million at the 31st of December, and vendor debt being the balance. And subsequent, as we've said here, subsequent to 31 December, the European bank that we use extended €3 million to us, and that paid down one of the vendor loans. So now we have much greater European bank debt and lower vendor debt. And we are currently negotiating term sheets for refinancing our debt on more favourable terms. And we look forward to completing that in this existing quarter, and we're hopeful that we'll get significant interest discount and therefore a less cash cost month in, month out. So just moving on to slide 19 here, and just to confirm, as at now and after the refinancing of the debt between our European bank and our vendors, we have 12.4 million euro worth of facilities in total. 7.5 is from a European bank and 4.9 is with the track vendors or the previous owners of track. Our weighted average interest rate continues to be something around 13%, and that's something that we are looking to improve on significantly in this quarter with refinancing. The European bank, we should just clarify, is a multi-drawdown facility. It's a revolving facility with maximum 6-month drawdowns, and they refinance each and every 6 months, and we're not obligated to pay any principal under that particular facility, and interest is paid upfront as a discount style facility. Our vendor finance, of course, is a 2-year bullet payment style arrangement where we have to pay €2 million in October 2017 and €3 million in October 2018, and we pay interest monthly to the former owners of track.
Okay, Christian, thank you very much for that. It's maybe a good time now to start addressing a number of the questions that have come through the audience. Stella asks if you could please remind us of the track and Q&A seasonality in sales and expenses. And just addressing that question, there is a small degree of seasonality. Typically the summer months are a little bit slower, but not materially in the scheme of things.
The European summer. Right?
The European summer, yes, given that that's the bulk of our revenue. Stella also asks, great to see track gross margins being so high at 89%. Is this maintainable? Over to you, Christian.
Yeah, look, the gross margins are maintainable, no doubt about it. I think Stella, what you need to be mindful of is that our marketing expense is actually below that in the profit and loss, and so I would encourage you to read in our half-year results within the review of operations what our marketing spend is as a percentage of our revenue, and you can easily then calculate a gross profit after marketing expense and look at the movements now that we've acquired track versus when we were just a question and answer business. But yes, we overall our gross profit is very pleasing, and we don't see any deterioration in our margins.
Okay, and Mark asks, when do we see the new Asian growth areas kicking in with regards to revenues? We did announce them recently, and typically the way it works is it takes a number of months, if not sometimes a year, to get connected to the telcos. As I'm sure people have heard me say before, the telcos don't just let anyone connect to their network. And then once we get connected, there's a process of approval from a product perspective, and then we commence marketing. So, there is sometimes a time delay of 4 weeks. Sometimes it could be up to 12 weeks from when we connect to the telcos to when we actually start seeing the revenue flow. And I hope I've answered that particular question. And just looking at some of the other questions. And Pat asks, what are the costs associated with entering a new market? Are these costs upfront and a low running cost? What impact will it have with regards to new jurisdictions? So first and foremost, the bulk of the costs associated with building the company, building out the technology, have already been expensed. For us to move into a brand new market, it's not very capital intensive. In fact, there's almost no CapEx required for us to launch into a new market. So it's about making the connections with the telcos, and that's just more about people time. Where there is a cost is in marketing. So when we launch into a new market, we would typically allocate around $50,000 as a spend, an initial spend into that market, which will help determine, the key metrics, the ROI, the CPCs, the CPAs, and all the key metrics that we use internally to measure the performance of our marketing. So when we move into a new market, there is basically an operational cost associated with marketing, and that's a variable cost.
Just on that, or around marketing costs, I see here that Gavin has asked a question around the expected marketing costs in the future. Gavin, one thing about the track business is that they actually spend a higher percentage of their revenue on marketing than our traditional Q&A business. So as we've commentated, we do expect a material increase in the consolidated marketing expense and a higher overall percentage of revenue for the second half. And that's predominantly, of course, due to track. But it's also, as Dominic has said, the Q&A business intends to forge new territories in the second half. And that does come with an incremental marketing cost of going into new markets, albeit it's not that large. But we do expect an increase in our marketing costs. We do expect an increase in percentage terms in our marketing cost. And because track is a CPA business, it indeed is a positive thing, because track particularly spends money on marketing knowing that it's going to get a particular ROI out of its investment. So in an odd way and in an ironic way, we actually look forward to a large marketing expense within track, because that means that we're driving gross profit.
Thanks for that, Christian. Stella asks, are the 10 million selling admin expenses the baseline expenses, or going forward, will there be further investment in customer acquisition?
So I think in relation to that, just to clarify, Stella, that there's a number in our report that's $10.4 million, and that includes marketing expense of $3.7 million. So to begin with, we need to wipe away the $3.7 million of marketing expenses before we start analysing what is the cost base. The cost base also includes, for the 6 months, some transaction costs within that $10.4 million for track, which is $900,000. So when we normalise what is our selling and admin expenses for the half year, it was about $4.4 million for the half year. And what I can say in regards to that is we do think that, of course, that's going to grow, because we will have track for 6 months, for the next 6 months, not for 2 months. But because track is a subscription business, and they have higher operating margins, our selling and admin expenses as a percentage of our revenue will go down overall within the blended business. So I think it's fair to say that we will approach $10 million for the 6 months. However, in percentage terms, the operating margins of the blended business are going to be more healthy than they are in this 6 months that we're reporting.
Yeah, thank you. Thanks for that, Christian. Sam asks, what jurisdictions, new markets, do we see the greatest area of growth for Crowd Mobile? And there's a couple of slides further in that we'll get into talking about the growth, but we certainly see big opportunities in Asia purely because of the population size. We also see significant opportunities in South America, and I'm sure everyone's seen the announcement from a couple of days ago about launching into Brazil and Colombia, which are two very strong markets, particularly Brazil. It's a leading market in South America, and it's taken us a while to get connected into those countries, and particularly from a Q&A business perspective, we're already answering questions in Spanish and Portuguese, which are the two main languages in Colombia and Brazil respectively. And so from that perspective, we'll continue rolling on, and our subscription business is already operating in a number of South American territories also. So just moving forward with the deck, just on slide number 21. We've already got a number of new products that we've launched, and what I'll just touch on is the Hillary app, where it's a white label partnership with a well-known French TV star. This is another example of the growth that we're projecting over the next couple of quarters, whereby we'll take the technology platform, take effectively everything that we've created, and white label it for groups, personalities, or brands that have a large audience, and we'll basically be working on the basis that they will be marketing to their audience, and we'll basically work on a rev share basis. So think of it more as a SaaS style model whereby we share the actual revenues. There will be a continuation of key products, particularly products that are targeted to a broader and older age group. We're currently looking at products in the health vertical, in the finance vertical, and in the veterinary vertical, where the typical ARPU, the average revenue per question, will be greater than $2, $3, or $4. And so without wanting to comment any further on it, because there are a number of deals on foot which we'll announce once completed, you will see Crowd Mobile moving what some people say is further up the value chain in terms of answering more professionally orientated questions. And I think that's ultimately the value in the 5 years of development work that we've created is a technology platform that, whether it's a question targeted towards a 16 to 25-year-old or a question targeted towards pregnant women or people who have a cat or a dog, the technology is used. Yeah. The next slide really touches on the expansion into Asia. I alluded to in a prior slide with regards to China. There's a little teaser on that particular page around China as well. I don't want to comment, and I'm not really at liberty to comment on it right now, but suffice to say that China is on our radar, and there will be a number of announcements around launches of some of our key products into that key market. And then the focus, obviously, as we've already spoken or communicated to the market, we'll continue doing brands with brand ambassadors, joint ventures. So once again, we announced a deal with, I'm not sure how many people here, it's maybe more of a program that's targeted towards 16 to 30-year-olds called Geordie Shore, which has 1 million viewers a week in the UK. And we've done a deal with the main celebrity there called Gaz, where people can basically ask ask questions, and we just work on a revenue share basis with that particular celebrity. And so it's really a way that they can get closer to their audience, and they can actually monetize their Twitter, their Instagram audience. So there'll be numerous other deals with regards to celebrities in that space. The focus will be to continue building out our in-payments network, and I know a lot of shareholders have heard me continually talk about our in-payments network. It's really the enabler that underpins everything that we do here at Crowd Mobile, and the reason that it's so important is the larger our in-payments network, the larger our addressable market. We're with the view that it's great to have compelling products, but if you cannot build customers in a really simple and seamless manner, then there's really no point. And so building out our in-payments network with the telcos, with Apple and with Google just gives us an opportunity to very easily build and monetize our customers. And that is a really important part of our business. I'm not going to spend any real time on the strategic acquisitions at this point. I think the focus is really on the existing business, completing the integration of the recent acquisition, looking to refinance our debt, and really trying to extract as much from the existing business as possible. Now we've got some time for some further questions. So what I will continue to say is please continue sending your questions through. We've maybe got another 20 minutes to go with regards to our webinar. Richard asks, consultant fees are up to 419K. Is this recurring, or was it attributed to the purchase of Track? And share-based payments of 1.3, is this a continuum? If so, how do you see it working? And Richard also asked about the cost of sales. They're presumably telcos or third-party commissions. And I should note in that point, and Christian
just pass it to me.
Yeah, Christian will sort of mention that all of our revenue is actually net of the telco. So Christian, I'll ask you to address those two questions.
Sure. So Richard, thanks for your questions. The consulting fees of 419,000, yes, it was up quite a bit, and we don't see that as being a one-off due to Track. To be candid, they are costs like multiple jurisdiction audit costs, compliance costs, etc. And that really is a product of being a dual listed public company as opposed to being a private company. So we do have outsourced enablers as a public listed company, and so those costs more or less are recurring. The share-based payments cost of $1.34 million, 300 odd thousand of that was a one-off financing style of cost to an external consultant, and $1 million of it was to internal staff, predominantly directors indeed, for this half year. And whether that's a recurring cost or not is indeed something probably better answered by Dominic on behalf of himself and the board. But share-based payments are a normal part of how we compensate here in our remuneration forums, so we'll probably best leave it at that. Our cost of sales at $3.687 million, yes, it doesn't include the telco's share of revenue, because we recognise our revenue on a net basis, of course, after the telco takes its average 50% of the retail value of the revenue. So it doesn't include telco commissions. It includes all of the infrastructure that enables us to do what we do, including the payments for our experts who answer questions all over the world on behalf of our Q&A business particularly. The overall cost of sales, of course, now that we have Track, will significantly go up in the second half and on a recurring basis, but it will be a lower percentage of revenue given that Track has very healthy gross profit margins as a subscription business.
And it's just worth noting in regards to the one-off, there was roughly 900,000 associated specifically with the Track acquisition. and that you can argue is a once-off because it was related to a very specific transaction. And so, yeah, from that perspective, I don't think there's going to be any more recurring track style. If we do look to acquire another company, there may be some other costs, but right now the focus, as I said, is internally. So just moving on to the corporate snapshot, which I think most people have seen before. Market cap of roughly 40 with an EV of just shy of 55 million. What's I think the key here is the debt interest cover of around 4.5 times, which in our view is quite healthy. We do know, and we've obviously acknowledged that there is some pressure on the share price at this particular point in time, and as I've spoken to a number of shareholders, my feedback to them is quite simple. As of right now, I cannot control the share price. What we can control as a management team is the performance of the business. We have direct influence on the products, on the countries that we launch into, and how we actually run the business. And as I've stated numerous times, we need to continue focusing on the business. Obviously looking to try and refinance some of the debt in terms of the balance sheet, and then at the appropriate point in time, the share price will look after itself. So I hope that answers that particular question. Now we've got a couple other questions. Pat asks, can you please clarify and list all outstanding short-term obligations with regards to the earn-out? So that's over to you, Christian.
Sure, thanks, Pat. So I won't list all of them because I'd be here for a while, but the material components of our short-term commitments, financial commitments, obligations are, we have an acquisition earn-out payment that's due in June 2016, and that's Euro 2.5 million. And then in October, we have the first vendor loan bullet payment that's due of 2 million euro. So again, for emphasis, by October 2016, we have Euro 4.5 million worth of track acquisition obligations to satisfy. And other than that, it's just business as usual working capital cycle.
Yeah, and the last part of the earn-out in January, that was paid out of cash flow. I think it's just worth noting that. Just on to some other questions. Mark asks, were there any surprises with regards to the track acquisition? Mark, in that case, I'm actually touching wood because the answer is no. It's as we expected. We did very thorough due diligence as part of that particular process. One of the risks that we identified in that business was the people risk, the vendors who are going to be with us until May. And very quickly, as we announced in December, we appointed one of our directors called Hans de Back, who's been involved in subscription style companies in the past. And he's basically the CEO of our subscription company. And so from that perspective, I think that's very positive for us. That significantly reduces the risk for that style of business. And so, yeah, from that perspective, I think that's a very important milestone for the company. Lynn asks, payments to experts to answer questions. How does CM8 deal with the discrepancy between the prices paid by phone users in developing countries and payments to experts in developed countries? Lynn, that's a really good question. We leverage something called the Big Mac Index, which is basically a model created by McDonald's and a bunch of economists to work out how much you can charge for certain products in each country. Obviously, when we go to Scandinavia, we can charge materially more than if we're in Hungary or Romania, just purely because of the purchasing power. And so, in very quickly answering that question, we use the Big Mac Index. Now, just please continue sending through your questions. Now, in terms of the peer analysis, I'm not going to really spend any time on this. I think we can pretty much take this as read. It's not our job to tell everyone that we believe that Crowd Mobile is undervalued. Ultimately, the market will be the ultimate judge of that. So what we've just tried to do here is just give the market a bit of an insight into some of the peers in the space, but I don't think we should be focusing any more time on that particular slide. In terms of the board, once again, just want to reaffirm how important it is that having a strong board that's committed, headed by Theo, who's been involved in technology for many, many years, and ran Melbourne IT, which was very much a stellar performance in the tech space for while he was at the helm. Now, just while I do that, there's a few more questions that have come through. Christopher asks, is there any update on the Crowd Butler business? Christopher, thank you for your question. As we outlined in the half-year review, the Butler business, as we originally launched, we basically pivoted. In effect, what that means is that we closed down the way that we were doing it. We took the learnings and now have applied that into a number of our other products. Some of the key learnings from there were trying to be all things to all people just doesn't work as effectively as being very, very focused. And the whole model, just to maybe give everyone some insight around Crowd Butler, was think of it as your own personal assistant, where you could basically text or use an app and say, well, can you organise me some travel tickets? Can you organise me some flowers for my wife? And we would basically click that ticket. And what we learned was there were a number of very important verticals, fashion, travel, and a number of others, where the bulk of the questions have come through. And so what we've basically done, instead of trying to be all things to all people, we've now taken some of those learnings, particularly from a mobile commerce affiliate style perspective, and have started applying them into our existing products. So think of, we've kind of taken the key learnings and now just applied that into our Q&A business. So I think that's that answers that particular question. So moving forward in regards to the slide deck, the top 30 shareholders, the board and management own roughly 20%. The track vendors, who are in escrow until October, own roughly 10% of the company. And there are a number of high net worth individuals with regards to that. Stella asks, any noteworthy investor feedback from the recent roadshows? What do investors see as the trigger, reduction of debt, etc.? Stella, I guess I'll break down that response into two areas. When we were in the US, the core focus was there wasn't a concern around the level of debt. It was just more about the percentage, the interest rate that we're paying. While the feedback that we get in Australia is a number of investors believe that we have too much debt on our balance sheet. And I must say it's a balancing act. On one hand, by having debt on our balance sheet, it just means less dilution for shareholders. But we understand that there's an inherent interest rate as well as greater risk there. And obviously with that, it increases our earnings per share versus raising a big chunk of capital to pay down the debt, which de-risks the business. And if our debt was halved, I'm sure we'd be having investors saying, well, why don't you have more debt? Why don't you bulk up and leverage your balance sheet? So I think it's one of those arguments or discussions that if you ask 10 different people, you'll get a dozen different responses. All I can say is that we're very conscious. We believe that that we're certainly paying 13%, as Christian mentioned, on average. We're currently got a number of term sheets that we're negotiating to bring that level down to a single-digit percentage, and we'll obviously announce to the market once that's done.
And probably the other thing to add on that, Stella, is that the other trigger we continue to believe is that this current half that we're in now, which will provide 6 months of identified track financial performance, will enable shareholders to have greater transparency. And so the other feedback is that the full year results will be a great opportunity for shareholders to understand how fiscal year 2017 is going to look.
Okay, thanks for that, Christian. And Lynn asks, With regards to the Big Mac Index, do we use that for our experts as well? The answer is yes. Obviously, the pay rate of an expert in Romania or Hungary would be significantly less than one in Norway or Sweden, where in fact in Norway a can of Coke will cost you $5. And so from that perspective, we certainly use the Big Mac Index as part of our pricing, not only from a consumer perspective, but also from an expert perspective. I think one of the other things, and feel free to send through a couple more questions as well. One of the other things that we're doing is that we're migrating and moving a number of our key people to our office in Amsterdam. We have already seen significant synergy by bringing the Q&A and the subscription business together in meetings, and whether it's discussing how we're going to expand our M-Payments network, how we're going to negotiate better rates from the telcos, to what kind of customer synergy can we extract from the business. We're basically making a move where we're moving a number of our key people to the Amsterdam office, and as some of you are aware, next week, in fact, I'm moving myself and my family to Amsterdam to be as close to the action as possible. And Christian, our CFO, will be basically doing 1 month here in Australia and 1 month in Europe. So he'll basically continue spreading the word to brokers and institutions while he's here. We've maybe got time for a couple more questions. George asks, have you thought about putting some of the apps or even all under the one umbrella, so customers are exposed to all the experts? The answer to that question, George, is yes. We have thought about it. It is in the works. What we find from if you think of a search engine optimization perspective, or even an in-app optimization perspective, when you have a particular app that does one particular thing, it's much easier to get into the rankings and to basically be at the top, while a general app would be much more difficult to promote because you're going across multiple demographics and multiple experiences or verticals. So have we thought about that? The answer is yes, and I wouldn't expect us to launch one this quarter. I think it's going to be more towards the end of this calendar year. I've got my email address there, dom@crowdmobile.com. If people have any further questions, I'll maybe sort of open it up for one or two more questions. No, there's no more questions coming through. So I'd like to thank everyone for their time on this webinar. We will now make this webinar available on our website, and we'll make an appropriate ASX announcement. So we'd like to thank everyone for their time, and look forward to catching up with everyone at the next webinar.
Thank you all. Good afternoon.